cycles. Not every area, every city, every state moves in the same direction at the same time. This is where being able to time the market, get into a market that is growing and rising in value is critical to get right. Property only pays you in 3 ways. Now, most investors understand maybe 1 or 2 of these things, but very rarely they understand in depth all 3, which we're going to go through in today's episode. And this is why a lot of people end up buying average assets. Hey everyone, welcome back to the Smash Property Podcast. This week's episode, we're going to have a chat about the only 3 ways that you can make money in property. We're going to talk through what they are, how you can assess them. So when you are looking at deals out there in the market, you can work out what is actually suitable for you and the goals that you have. We're going to talk through all that and more in today's episode. If you're new, my name is Nick V. I'm the founder and director of the Smash Property Investing Buyers Agency, where we help property investors find and buy investment properties suited to their specific goals and needs, and not just off some hotspotting list or whatever the hot areas are of the moment. If you get some value out of the episode, appreciate a thumbs up. Consider subscribing if you haven't already. Now let's get into this episode. Now, this topic might seem a little basic if you are already an investor, if you've done any sort of level of research, but I think it's always important from time to time to take things back to basics, back to baseline, like why are we doing certain things? And if you're new to investing, there is definitely going to be some value in it for you. Now, property only pays you in 3 ways. Now, most investors understand maybe 1 or 2 of these things, but very rarely they understand in depth all 3, which we're going to go through in today's episode. And this is why a lot of people end up buying average assets. Okay, so I guess the issue that we have today is that there are, a lot of buyer's agents out there, and I seem to always be having a little niggle at buyer's agents these days, but they tend to make it very mysterious, right? Like the buying journey is this whole thing that, only they can solve. And it's like this, bit of smoke and mirrors going on with a lot of this stuff. And it's not that hard, all right? People sort of get in their own heads about property and all these sorts of things because there's so many different views and opinions online and all these sorts of things. And I'm seeing a lot of people just fundamentally miss the basics of what this is. So we need to forget the headlines, forget auction results, forget, predictions and all these kind of assumptions that people have. None of that stuff creates wealth. There's only 3 levers that create wealth. And when you can understand them, that means you can then understand what you are looking for, because every investor is going to be looking for something different that is suited to their goals and their needs. Once you can understand that, everything really just kind of clears up, right? It's like we put the glasses on. I'm like, oh wow, I can see what's going on here now. So what am I talking about? The 3 things. All right, we've got cash flow, which I know a lot of investors understand, and some might not. If you don't, that's totally fine. We'll get to that in a second. Capital growth, which is, predominantly, I would say most people kind of get that. But then the third one is the uplift. And this third one is where a lot of people overlook the power of uplift. And we'll talk about that and what it is in just a second. So let's talk about cash flow first. Now, this is where I see so many new investors get caught up on cash flow. Right? The reality is with cash flow keeps the asset alive. It keeps us in the game, but it doesn't build wealth. It doesn't make us rich. So for those that don't know, cash flow is essentially the rent minus the costs, and what are you left with at the end of the day? Now, very typically with real estate in Australia, particularly residential, is that it is not a very good cash flow asset. Right? The yields are pretty atrocious, right? We're talking 3, 4, 5, 6, sometimes 7% we can stretch it to for a residential deal. Now, I know there are these, what do you call them? I always hate them. The co-living bullshit, right? I don't do any of that stuff. I don't recommend you do. And if you do, stress test the numbers, because They promised all these yields and it never works out. Anyway, I'm not going to go into it because if you know me, we've gone down some rabbit holes before. But typically, your real estate residential is going to have an atrocious yield. Okay, so again, cash flow is the rent you get for the property minus the expenses. All right, so it's there for us to hold the property. It's not there to build wealth. You don't build wealth with cash flow. So the cash flow side or the rental yield side really only comes into play when we're at the tail end of our journey, when we want to, I guess, cash in on the portfolio and go, okay, cool. Now I want some income to come through. But we've got to build up to that. You don't go into your first deal looking for a cash flow play, right? Because I'll explain why in a minute what we should be focused on. Okay, so the cash flow is a part of the journey that will grow over time. The more assets you start to stack, the more the cash flow then should become a consideration. Okay. If we focused it from day one, we typically buy the wrong asset, don't grow our wealth, kind of get stuck at maybe 1, potentially 2, and that's kind of as far as we can sort of go. So if you're wondering how to calculate a rental yield, it is essentially the rent minus the costs divided by the purchase price of the property gives you the rental yield. Now, you need to be cautious that you might hear and see yields being quoted online or as part of a deal that you're looking at. Typically, yields are going to be calculated at a gross level. So there's going to be a gross rental yield. Typically, you'd see 3, 4, 5% in most areas, right? It's largely going to be a gross yield. The gross yield doesn't factor in all the costs. The net yield is what you want to be paying attention to. And typically, like I said, with residential portfolios, the net yield is going to be very low, but the yield over time on purchase price improves dramatically the longer you hold the property. And if you watched any of my other podcasts, I've always said the properties that I've owned, typically around the year 5 to year 7 mark of holding the property is when they typically flip from being a negative cash flow asset to being either, neutrally geared, or sometimes they shift into positive. I've got a few properties in Brisbane now I've held for 5-ish years, and they're actually flipping into positive cash flow territory. This is why I say focus on the growth first, cash flow comes second. All right. So most high yield properties are high yield for a reason, because they've got low demand, low growth. They're high yield because there's some element of risk involved with it, right? The properties that grow your wealth, they don't have great yields, right? Why? Because they're growing your wealth, okay? So cash flow is one way that property pays you, but it's not the way in which we build wealth. The way in which we build wealth is through capital growth. So let's talk a little bit about that. It is the primary driver for you as the investor building your wealth, but a lot of investors don't understand how it works, or they don't pay attention to it. So the main driver of capital growth, and you can argue about this, till the cows come home online, everyone's got opinion of what drives capital growth. It's really simple. This is where demand outstrips supply. That's it. That's what drives capital growth. And I hate to say it, you and I don't have control. No one has control over capital growth. The market controls capital growth. So you can't force it. You can look at conditions that are happening in a particular area and make an assumption and a best guess as to kind of what's happening, as to where things might land, but you can't guarantee it. You can't, foresee what's going to happen, because anything can happen. But largely, if the demand is outstripping supply in the market you're looking at, that's a pretty good indicator of prices, growing in value over a period of time. And my own, just speaking, from my own portfolio, not even the clients that we have worked with, in that every property that I've bought, particularly in the beginning, was bought with the increase of value in mind. I never bought because I had a good yield. I bought because market conditions were looking good in the areas I was looking at. If you know any of my stuff, my portfolio is largely centered around Brisbane, at least in the beginning of where I started buying, because market conditions were good. I was looking in Brisbane, I was like, okay, properties in Sydney, $800,000-900,000+ for an entry-level house in Sydney, whereas Brisbane, I can get something for under $400,000. That's like 3 bedrooms on a 6, 7, 800 square meter block of land. That to me at the time was undervalued. And I'm looking at it going, okay, I can see the demand in Brisbane, population growth. There's a very constrained supply. I can afford that market. Let me get into that market. And the growth on every property has allowed me to continue growing the portfolio, along with me continuing to increase my income, because serviceability is obviously important. But the key message is that if you're looking to grow your portfolio, you're going to need some element of capital growth to go along with that. Importantly, if you are looking at, and I see some investors that are new and or don't have the level of insight, they look for high growth suburbs, right? It's typical. Hey, Nick, you just told me buying a high growth suburb. Yeah. Don't just go and download a high growth suburb list. Why? Because those suburbs have already had the growth. This is where you've got to find the market that is at the early stages of an upswing cycle, right? I've mentioned on a previous podcast recently about property market cycles. Not every area, every city, every state moves in the same direction at the same time. This is where being able to time the market, get into a market that is growing and rising in value, is critical to get right. And this is where being able to do your research on what those markets are is going to be able to see you go from 1 to 2 to 5 to 10 properties in a very compressed time span, like I was able to, because you're looking at that kind of information, not just, hey, what's the highest growth that's happened, but where is the growth gonna be? And to give you an example, I was looking at Kalanga in Brisbane for one of my first properties, and Kalanga at the time had shit historical growth. It was like, you look at the data, you're like, why would I buy there? Nothing's happened there. But I was looking at the market conditions in Brisbane going, okay, I know this hasn't had a huge amount of growth. I understand how property market cycles work, at least to some degree in the beginning. Let me take and there's no way of saying it. It was a gamble, right? Because there's no certainty with it. So there was a bit of a gamble and a bit of a risk to go, hey, this area hasn't grown. Let me get in and ride that wave. And I'm ever thankful that I took that risk to do that, because if I didn't, my portfolio wouldn't be where it is right now. So that's where, having a form of strategy, having, an understanding of your risk appetite, and I talk about it all the time, but then actually taking the action, right? Strategy, risk appetite, action. We've got to kind of align all those things together. So you're not just hoping it will grow. You've done the work to get there, and you've mitigated as many risks as you possibly can to get there. So cash flow is one way that allows us to get paid from property. Capital growth is another, probably the most important one in terms of building our wealth. But let's talk about the third one, which is often overlooked by, I'm going to say 99.9% of investors, and that is the uplift. The uplift is the value that you create. And this is where people completely miss the mark on this a lot. Uplift accelerates the equity gain that you can get from your property, but it requires you to be disciplined with what you are doing. So what am I talking about uplift? I'm not just talking about renovations of a property. That is obviously one that, I'm a big fan of, because you can do things quite quickly, but it's not for every investor. I wouldn't recommend it for everybody. So cosmetic renos is one thing. Adding a secondary dwelling might be another. Reconfiguring the property, which is one that most people don't even think about. So reconfiguring the property could be, hey, you've bought a 3-bedder, maybe you add a 4th bedroom in. Typically, you might see 50 to 100 grand in gain just from that alone. Maybe you want to reconfigure. Maybe you can add in a secondary bathroom, reconfigure the floor plan to make it more livable, open it up a little bit. All those sorts of things can, not always, they can add a significant chunk of value into your property. Now, remember, capital growth is out of our control, right? The market dictates capital growth, but value uplift, that is 100% within our control. And this is why I'm always looking for value in the market. And this is why I would say, don't buy a property just because it looks nice. Don't buy it because you would live there, right? Remember, it's an investment property. It's not your principal place of residence. So looking at a property through the lens of what can you do with it? Maybe you don't do the renovation now, but maybe in 5-10 years, you might have an option to be like, cool, now I've got a bit of capital behind me. Now the market's sort of grown a little bit. I've got a chunk of equity I can pull out and put 10, 20, 30, 40, 50 grand into a property, maybe add the bedroom, add a fourth bedroom or a fifth bedroom, add another bathroom, maybe add the secondary dwelling. Maybe I renovate the property to increase the rental yield of the property to make sure I can then get a higher rental income and then potentially might have some positive cash flow. All of those sorts of things, we've got to look at the deal we're looking at today to see what it can do in the future. And the very best thing I see for investors is creating those options, right? Every property I bought looks like crap, right? Like the house that I wouldn't live in. That doesn't mean to say it's shit. It's just that it's not my dream home, right? But I bought it with the option to go, okay, every property that I bought, I have a renovation cosmetic uplift option at some point. Every house or most of the houses, particularly in the beginning, are on large enough blocks of land where I'm able to potentially build a secondary dwelling at some point. There's a couple of them which I bought on corner blocks so I can potentially knock down, build a duplex. Am I planning to do any of that in the first couple of years? No. I'm building the portfolio in the first couple of years, but I'm doing it with options in mind. I'm doing it with the future in mind to go, okay, I might not do it now, but I've got options later down the line to do that. So underrated. So cosmetic renos, granny flats, reconfiguring the property, potentially subdivision, but it's very rare. A lot of people, I want to buy and subdivide. It's like, yeah, but there's also the infrastructure costs and there's a lot of things you got to factor into a subdivision, and it doesn't always equate to it being worthwhile, particularly if you've got no secondary dwelling on it, right? A lot of people just want to buy a big land, cut it in half, sell the other bit of land. It kind of really makes sense when you build two properties, then you cut it, because then you've actually got a dwelling on there that you can then sell and cover the costs of that subdivision. So not every property is going to allow you to be able to do this sort of stuff. There's only it's got to be a certain type of deal, and that is the trap, because a lot of investors look at the portfolio from an emotional lens. Like, they're not seeing it from what the numbers say. They're not seeing it from the opportunity. They're not seeing it from the value lens or the uplift potential. And this is where, like, you look at the ATO data, right? Like, most people get stuck at 1, maybe 2, sometimes 3, and then that's it. It's game over, because they miss that part of the equation. So you've got to create value. So don't just equate, I've got to spend money on the property to uplift value. No, you've got to create the value. The value's got to come from somewhere, and it generally comes from adding a secondary dwelling. I always talk about it. Adding another bedroom, that's a big thing. And you can get obviously increases from the cosmetic stuff. Cosmetic stuff will largely increase your rental yield probably first, more so than an increasing value. But a great way to do this is, if you're looking at a deal, look in the area and go, okay, if I buy this property, right, and it might look like shit, if I spent some money on it, what are the other properties in the area that might be renovated? What are they selling for? Because it's a great way. You can then see, all right, cool, that property down the road is selling for $700,000, fully renoed. My property I'm able to buy for $580,000, whatever it is. I spend some money on it, I uplift, then I can potentially sell it for what this property is going for down the road. So it's a great way to kind of see down the line as to, you spend money, what can you potentially get out of it? And again, capital growth, you can't do that, right? Capital growth, you're just reliant on the market to dictate what the price would be. So this is the 3 things, right? Cash flow, capital growth, and uplift. Those are the 3 ways in which property can make us money. Now, the great investors that I see combine a couple of these things together. So the best deals really have 2 of those things, very rarely have 3. They're very rarely going to cover cash flow, high growth, and have uplift potential. It's very, very rare, but if you can find it, more power to you. So the growth and the cash flow is the most sustainable combination. And I'm not saying, when I say cash flow, I'm not saying that it's got to be positive cash flow. I always talk about having a balanced portfolio, right? Building a portfolio is a game of balance, right? In the beginning, we're sort of heavily focused towards growth. We want the growth of the portfolio to go up. The reason being is we want the growth so we can extract the equity to use as a deposit to go again. That's the main focus. It will come a point in time, as every investor does, where your own personal cash flow, you're like, hey, this is getting a bit tight here. I do need a bit of a yield play. At what point in time that happens is really dependent on you and your income. And this is where, hey, maybe we need to pivot back to a more, a yield strategy, secondary dwelling, maybe buying a unit that might have a stronger cash flow, whatever it might, maybe it's commercial, whatever it might be, to kind of swing the balance that way. So that's typically how most investors would do it. Property grows, they focus on pulling out equity, they have to then pivot to more cash flow deals, and then they just keep leveling up like that. The fastest way that I've seen a lot of investors do it is they find growth properties that need an uplift. Right. And this is not for the faint of heart. You've got to have some experience and you've got to have discipline, like I mentioned with this, right? But that's the fastest way, because you buy a shit looking property in a high growth market. You buy it at a great price, you uplift the value, and then bang, you've got ideally a huge amount of equity sitting there that you can, some investor, the reno flip type thing. Or I'm seeing less and less of that, and it's more no, I'm not seeing less than that. I'm seeing investors buy, add the value, extract the equity, and go again. There are still reno and flippers out there, but the market condition is a little bit different for that, as it was, more so than it was, 10, 15, 20 years ago even. Or you go cash flow play plus uplift, right? So I'll find a property that's got a nice yield, and then I do a bit of value add to it. This is kind of good for, you can manufacture your own, you get a nice yield property, you manufacture your own growth, and then potentially you can pull out that equity to go again, and you're left with a property that's got a nice yield. Very rarely you're going to find all three. Again, if you do, it's very rare but powerful. So good on you for doing that. So before you buy anything, and this is the point of the episode, before you buy anything, you've got to be able to identify what lever are you pulling and why, right? Don't just buy for any other reason. Buy because it is either a cash flow deal, it is going to grow in value, or you need the property to grow in value and you've done your research and you know why, or you're buying it because there's that uplift potential, aka the manufactured growth potential with the property itself. So, when you're next scrolling through realestate.com, ask yourself one question. Which of the three drivers that Nick spoke about is this property actually giving me? Because if you can't answer that in 10 seconds, skip the deal, go to the next one. There's thousands of them online. So again, stick with those drivers, understand them and what you need at this point in time. And if, again, the deal ain't stacking up to that, time to move on, man. That's as simple as it can be. So look, if you out there looking to do it yourself, you absolutely can. If you're finding yourself get stuck with the research, or you're stuck with, hey, I don't know what areas, I don't know what I should be looking at. I'm not really confident. Hey, I might know, but I'm not really that confident on pulling the trigger. You need help. You need put a plan, strategy. You just need peace of mind. That's the value of the service that myself and the team can deliver for you. So if you think that is something that is going to be of a benefit for you, and you're watching on YouTube, there's a link in the description where you can book a call with my team. It doesn't cost you anything. We're not going to pressure you into doing business with us. It's going to be very simply work out a couple of questions. Can we help you and your situation? If we can, we'll show you what that looks like. And if we can't, we'll tell you, hey, we can't help you. Unfortunately, we're not going to be the right fit. So property is an amazing way to take control of your life. Like, I've said this on a few podcasts. If it wasn't for property, I wouldn't be in the position that I am in now. And I'm by no means fucking balling or whatever. Like I live a great life, live on nice part of Queensland, kind of do things I want to do whenever I want to do them. But I'm still building, right? Like it's one of those things that you kind of never really stop. But the point being is that one property alone can make a big difference to your overall existence. And so what I'm really talking about is maybe you fucking hate the job you're in, or you want to take some time off and you've got a property. Maybe you can fucking sell the property and you might have a couple of $100,000 in equity. That's going to save you having to work for a couple of years. As just an example, one example of fucking dozens we can come up with as to why property is a good thing. Yes, it is risky. Yes, there's no guarantees in this world, but fuck me, it's been pretty good for me, and it's been pretty good for the investors we've worked with, and it's been pretty good for centuries prior to this point in time. So I don't really see a huge amount changing over the course of the next 10, 20, 30 years. So I just wanted to leave you with that. If you got this far in the episode, I appreciate you watching, and you've got this far. Give the thumbs up button a bit of a workout if you're on YouTube. If you're on Spotify, I don't know, I'm pretty sure you can like the episode. Leave a comment. Say hello if you got this far. Like, you're obviously interested in what we're doing. So say, hey, Nick, yeah, I like what you're doing. Or do a topic on this and whatnot. That's all we got time for. Hopefully there is some value in that. There is actually very important value in that episode, which should help you now find deals that are going to suit you. And you should be able to now eliminate all the crap out there that's online, because there's lots of it. Until next time, thanks for watching. I'm Nick V. Catch you soon.